Okay, good afternoon, everyone. Today we are going to review the portfolio. It is Sunday, and right now the markets are closed. Right now, the portfolio is down 0.31%. This was in the last trading day, which was Friday, and in the after hours, I was up 0.3%. So we're going to quickly talk about what's been going on in the portfolio, guys. I know I've recently made a video talking about how the markets were tanking. What we did was we essentially held it out, and it looks like the portfolio is starting to recover just a little bit, but we are still, or we have taken a massive dive. We have taken a nosedive down from our latest milestone, which was 25,000, and we went all the way down to about 22, I believe, or closer to 23. So that's pretty significant to see that all of the gains that we had was essentially wiped out in about a week or so, maybe even like maybe 2 or 3 days. Essentially, all gains and returns were wiped out due to the trade war. So we're going to quickly look at our portfolio. As you guys could see, nothing was sold. Nothing was sold off. We essentially held it out and we didn't touch anything. But we can take a look at this Visa call option. And the last video, I was down almost 48% with this Visa call option, and I said that I wasn't going to take a loss on that Visa call option. What I essentially did was I didn't look at my portfolio a lot. I just tried to hold it out, and it looks like Visa's starting to recover just a little bit. Right now, I'm still down 9%, closer to 10%, which is $112. But this call option has an expiry date of January 17, 2020. So I have plenty of time to hold this call option and see if Visa can make its way back up to the average cost of which I bought it. It has a break even price of about 191, which I definitely think that's realistic. I definitely can see Visa getting to $190 towards the end of the year. But what concerns me a lot about what's been going on about with the markets and the trade war and all the news and speculations. I'm gonna talk about what I'm trying to do with where the portfolio is going to be going now. And again, I've talked about how time decay is really important and how theta will continue to decay the contract as long as I hold it. As the longer I hold this contract, the worse it'll get. And like I said, I gave myself some protection by buying it by buying it so far out so that I'm not affected by the expiry date. So a lot of people who trade options, they buy their contracts towards about 2 weeks, 2 weeks towards the expiry date. And if the market tanks, then they don't have enough time to regain those losses. So they end up selling for a loss, or they end up having the contract expire, which means that they still will take a loss. So right now, the volume, well, this was Friday. The volume was over 200, so that's pretty good to see. It looks like there was a lot of interest with this call option contract. But again, guys, the longer I hold it, theta will continue to decay. And yeah, that's all I have to say about that contract. So what I will say is that I definitely would like to use this equity on something else, but I'm going to continue to hold because I have plenty of time to hold it. And I will talk about what I really want to do with that $1,100. Right now, I'm still down $112. So you guys can see that nothing was sold in the portfolio. We held it out and we're starting to recover, but it would be nice if we can get back to that 25,000. I have not been putting any money into the portfolio at all, but I plan to do so once everything in my life has sort of just sorted itself out. Right now, I'm still doing a lot of moves, a lot of plans. But Apple 201, we're still big up on this stock, 11%, so $213. Nothing was sold, and I'm pretty happy that I didn't do that. So next area, energy 216. Right now I'm up $84. I definitely think that this was a very, very smart move to buy this stock, even though it was overvalued, because it does give me some protection. It is really defensive, and it really is a pretty a high growth stock. We can take a look at the past 5 years. It's been doing very, very well. I would say actually extremely well, up 126%. So next era energy might be a little bit overvalued, but it is a decent utility. Actually, I think it's one of the better utility stocks on the market, if not the best utility stocks on the market, as it continues to go up and it continues to fight off recession movements. So it continues to do well during this trade war, and I definitely think that this was a good move to buy this stock to give the portfolio some protection. So Johnson & Johnson 132. We are still holding Johnson & Johnson, and we are still down $76. I have 15 shares. I definitely think that I can add some more shares, but I don't want my portfolio diversity to go over 10%. Unless it's a stock that I really, really like, something like Apple or an ETF or something like that. I don't really like my stocks taking up a huge chunk of portfolio diversity. So that's why we are still holding 15 shares at an average cost of 137, which I believe that is still high. And I definitely have a buying point for Johnson & Johnson around maybe around $125 or so. So I believe that that's definitely fair value for Johnson & Johnson if you can buy it between $120 and $125. Still a dividend king. It is still a pretty good health stock. I think that once the lawsuits sort of clear itself out from this stock, I definitely see the stock going to a price target of $160. But the combination of the trading war and all the lawsuits have really just stagnated Johnson & Johnson, and they haven't been growing to many investors' delight. So Disney 138, they actually did not have a good earnings report. A lot of investors or Wall Street expected the earnings report to be higher, and they missed earnings, so the stock tanked. We could take a look at the volatility right here. It got up to about 146, and it dropped all the way down to 134. So I definitely think that Disney is going to be a very, very long-term play. I think that this stock is still extremely undervalued, and I have a price target for Disney around $175. So the reason why I have that is because of what they've been doing with all the movies, and the theme parks seem to be doing well. However, I would say that a lot of news that affects Disney is that it missed Wall Street expectations, and that's the reason why the stock took a nosedive. Because I think Wall Street, what they expected was the news with all the movies that were doing well. They thought that the earnings would be a lot more higher, and which they weren't. But I think Marvel Endgame did very well based off the last earnings report, or whatever the last earnings report actually was. And I just think that Disney, once we find out that Disney Plus is actually profitable, it will continue to go up. So a lot of people, what happened during this spike right here, and I actually own the stock right here, but I ended up selling because I needed to move the money elsewhere, which was a terrible mistake because I could have got Disney much lower than that. But a lot of investors bought the news. So what a good strategy to do in the stock market is you want to kind of buy the rumor and sell the news. So a lot of investors did that. A lot of investors started buying the rumor, and they had plenty of time to do that because throughout most of 2018 and into 2019, the stock hovered around $110. So that's all I have to say about Disney. It is still a pretty good stock, and it's definitely going to be a long-term holding in the portfolio. Procter & Gamble 116. I'm up $81. They continue to do well. Their last earnings report was very good. I don't have a lot of news with them, although I would say their PE ratio is looking pretty high. I know Robinhood's numbers are not extremely accurate, but I would say that this stock definitely is overvalued, and I bought it overvalued at a portfolio diversity at 9%. But I think also that the combination of Next Era Energy and Procter & Gamble has really it has protected the portfolio from that last market dip. So thanks to the trading war, and I just don't see the trading war ending anytime soon. So we need defensive plays like this inside the portfolio where we have Nextera Energy and Procter and Gamble sort of protecting the portfolio. And I think that those were two very realistic and interesting moves that I have done. I have bought into the high because I normally don't buy stocks when they are overvalued, but 20 shares, I'm up $81, and I definitely think that Procter & Gamble can go higher if the trading war escalates, because a lot of investors are going to try to buy those safe haven stocks like gold, consumer staples, defensive utilities, and that's a big reason why Nextera Energy and Procter & Gamble are in the portfolio despite them being overvalued. Boeing 337. I continue to take a loss with Boeing, but I traded them out for 3M. And let's take a look at where 3M is at right now. I had an average cost of $165, and I believe I sold it around $180 because I just had no faith in it thanks to the trading war. And if my phone is accurate right here, it looks like it took another nosedive back down to 163. So it looks like that was a pretty good idea to sell 3M, but all the industrial stocks or diversified industrial stocks have been taking a nosedive. And 3M is right back down to $163. I continue to see them struggle with the trading war. I definitely think the analysis ratings are spot on. This is a company that is still looking like a pretty good buy, but I would not touch them above $165. I might consider putting them back into the portfolio. It depends on just how much they dip down. But right now, I have more faith in Boeing figuring it out because they they're a necessity. They have great planes, and 3M, they're a very, very good established industrial, but Boeing is industrial, is aerospace and defense, and I don't know. I just have more faith in them. I just have more faith in them at this point in time, so that's why they're in the portfolio, and we are going to get a dividend thanks to our 5 shares, which is $10. So that is actually not too bad to see. And 3M would have paid us more. They would have paid better, but Boeing is increasing their dividend at a much faster rate than 3M. So Boeing looks like the stock we're going to go with. AbbVie is at 65.71. My average cost is 66.63. I am taking a loss with AbbVie, but again, that portfolio diversity is lower than 10%, which I like. And I sort of just taken a Warren Buffett sort of strategy by keeping my diversity amongst the stocks around 10% or so. So the portfolio the portfolio is more balanced. But AbbVie, I mentioned how they acquired a company to not be so dependent on Humira, and they have a extremely good dividend yield. It looks like the dividend yield is not being posted there, but I don't know. I don't know. That's kind of weird how their dividend is not posted. Did they cut the dividend? Did they cut the dividend or something? I'm not really sure. I haven't seen any news that they cut the dividend, but Robinhood does not have a dividend yield for them yet. They may be updating dividend. I'm not really sure, but as long as AbbVie continues to pay good dividends and be a strong market cap stock, I know they've lost a lot of market cap thanks to trade volatility, but as long as they continue to do that, I will continue to hold. I sold Pfizer due to a stop loss, and I put AbbVie in the portfolio. I think that these are very respectable levels to buy AbbVie at. So let's take a look at more stocks in the portfolio. I think this is the last stock, Amazon. Right now, Amazon has tanked thanks to the trading war. A lot of profit take has been going on, but a portfolio diversity at 7% and an average cost of closer to $1,900. So in total return, I am down $62. Amazon is just simply in the portfolio to give the portfolio some opportunities for growth. And, I do have that Visa contract doing that, but I'm going to continue to hold Amazon for the long term here and see what it does. It really needs no explanation as far as what they're doing. Like I said, Jeff Bezos is trying to monopolize the entire world. And, that's pretty much it for Amazon, I guess. And then we're going to get into our ETFs. I only have 2 of them. Vanguard S&P 500 ETF, which took a massive crash. let's take a look. Well, it actually didn't crash, but it's closer. It was down 5% August 5th, 2019, and I continue to hold this, and I'm down $73. So VOO, I wanted to focus on the S&P 500 a little bit more. I had VTI, but VTI composes itself of smaller cap stocks, and it's really just a broad index where it takes smaller cap stocks, medium cap stocks, and high cap stocks and just bundles it all together. And Vanguard S&P 500 ETF, ticker symbol VOO, doesn't do that. It simply just focuses on the S&P 500. So I think that right now, as a safety precaution, I want to just focus on higher cap stocks, like companies with giant market caps. And that is the reason why I bought VOO and traded out VTI with VOO. And not to mention that I wanted my ETF exposure to be around 30%. So that's another reason why I did what I did. And PowerShares S&P 500 ETF, I'm still up big on this. I've talked about this ETF before. The dividend has not been announced yet, but I see them doing that very soon. Just another defensive ETF. The real estate portion of this ETF, I think that's been dragging the ETF down a little bit, but definitely going to buy some more if it ever gets back down to my average price. So my ETFs, I have about 30% portfolio diversity out of 100%. So what I'm trying to do, at least what I'm going to look at, is I'm going to probably add some gold into the portfolio, guys, because if what this drop pretty much taught me, excuse me, I'm losing my words here, but what this drop pretty much taught me was that I need to put some more defensive measures into the portfolio. I know Nexera Energy and Procter & Gamble, they kind of just held their own there with that mini correction, but stocks like McDonald's did very well. Let's take a look at McDonald's right quick. And I'm trying not to make this video too long. I know I'm looking at all these other companies that are not into the portfolio, but I think I was looking at McDonald's the other day, and I think they also did very well. Yeah, so it looks like, oh, that's my, I think I just hold, oh, there we go. So, yeah, they did okay. They did very well. They didn't dip as much. They only dip about 1%, closer to 2%, and then they went back up. So McDonald's is doing very well despite it being overvalued, and I think that's what investors do when they see the market tanking like that. They try to go to safe haven stocks like Procter and Gamble, McDonald's, defensive utilities, gold, VIX, put options. They try to do stuff to manage the losses. So, but we're going to be probably buying a lot of this ETF. It has an expense ratio of 0.25, which I think is, I actually think it might be 0.20, or 0.25 is either or, but I think that's reasonable. SPHD actually has a higher expense ratio than this, but I think that if, like I said, what the last correction or mini correction has taught us is basically to have a more defensive plays in the portfolio moving forward, because again, like I said, I don't see any end to the trading war. I don't see any end to the madness, and the markets are very vulnerable right now in terms of any news coming out. Like, it seems like any type of news about China or something happened in the world where the GDP fell, something like that, or just any kind of news is really just scaring investors. And it's probably good to bulk up our portfolio or our moves with this sort of play. So I'm going to be focusing on this ETF, which is gold mini shares. It's around $15 right now, which I actually want to probably buy it around $15 or so. But for the past year, you can see definitely a lot of investors have been moving capital into gold. And I still think that there's time to do that, because we aren't officially into a recession, but this is the longest bull market ever. And I definitely think investors are on their tippy toes right now. I definitely think that we are skating on thin ice, and any news will pretty much tank the market. So past 3 months, 15%. So we are definitely seeing a lot of movement into gold. And that's what I'm going to be doing too. I'm going to try to get in I wouldn't call this early, but just get in low enough to where gold would start taking off, and I believe it already is. It really has taken off already. So that's what our next moves are going to be, and we're going to essentially have the portfolio in its entirety, 60% stocks. Apple, Nextera Energy, Johnson Johnson, Disney, Procter and Gamble, Boeing, AbbVie, and Amazon will be 60%, and then 40% is going to be ETFs, which will round out the portfolio to around 100%. So 60 plus 40 will be 100% portfolio diversity, which will include everything: ETFs, gold, and stocks. That's going to do it for portfolio, guys. I tried to make this portfolio quite simple. Try to go through everything about what our moves are going to be moving forward, and I definitely think the gold mini shares is going to help out. This bull market can't last forever. Any news that comes out is pretty much scaring investors to sell, and I wouldn't even call them investors at this point. These are traders that are monitoring the markets, and they are selling off their own fears and panic. So we're going to buy gold mini shares, and we are going to buff up our defense for the portfolio. But anyway, guys, that's going to do it, and I'll see you guys next time, and have a good day.